to pursue the wealth.
Welcome back to another episode of the Pursuit of Wealth podcast. It has been a hot minute since we've recorded one of these bad boys, for multiple reasons. Not because we don't like doing it. We freaking love doing this podcast. It's one of my favorite things to do. But we've been super busy with real estate, our real estate team, and also like running some other companies that we have too. Our cash offer company and our flips have been blown up, so that's taken up a lot of time. And then the other thing is, it's just really hard. It's really hard to line up guests, especially here locally. And we're in a pretty small town. It's hard to find business owners or people that want to come on the podcast. And then if you don't have a guest, I've got to try to create some kind of content that I'm going to just speak to a camera about. And it's really hard to do that too. I like to have conversations, and it's not really a conversation when you're just talking to a camera. So today in the office, not today, it was a few days ago, Jace, one of our avid listeners, was like, dude, when is the next episode coming out? And I'm like, you know what? I explained my situation, and we had the brilliant idea that Jace is now going to be the co-host of the podcast so that I never have nobody to talk to, or that I always have somebody to talk to.
Yeah.
That's a better way to say it. So, and Jace, I think too, can like ask questions. I want him to kind of use a perspective of like an audience or a listener, and like, hey, what would, if I say something that maybe is more high level, or, he's like, well, what if somebody's never done that, or explain that? I think I can talk at a level because I do it, and, I might assume somebody knows something, which they don't. So he can kind of try to bring a perspective of like, well, explain that a little bit, or well, what would you do if you were in this situation? So I think it'll be cool. It'll be cool to have somebody that can bring in we can always have a conversation with. And then also when we're talking to a business owner or an investor that we bring on, have a different perspective, because I can ask questions that maybe I want to know or that I'm curious about, but it's always cool to have another person that can also bring in some perspective and question asking. So welcome, Mr. Jace Wright.
Thank you.
Yeah.
Thank you.
I'm
Super
excited.
excited. Maybe if you complain enough about not having episodes to listen to, that's how you get invited to come
To be a
and give
guest.
solution to the problem.
Yeah. If you're a listener and you want to try to get on the podcast, maybe just complain about us not posting, and we'll invite you.
No, I'm excited to be on. Kind of like what you said, it was a nice way of saying that, like, I'm not like high level on investing or anything like that. Like, I know basic stuff. So I'm going to put myself on the line and expose my knowledge, which isn't much, to be able to ask dumb questions. Cause I know that maybe a lot of the listeners are kind of in the same boat, and they're either just getting started or wanting to get started and don't know where to start. And so that's going to be kind of my goal with the whole process is.
And I just thought of this on the spot.
Okay.
This can even be like a journey. This is going to be like, you're going to be now my experiment. Like, we're going to talk about principles and doing stuff, and then I'm going to like force you to do it. And then it'll be a progress, and we can update the guests.
Yeah.
Then like when you buy your first rental or invest in your first thing, we can like share that.
Yeah.
Yeah. This is going to be great.
Day one of investing.
Day one. Yeah. We're going to start from
Investing
square one.
101.
Yeah. And then we can have a true journey of somebody that goes along it, where we don't just talk about it. Like, hey, we're going to make Jace do it.
Let's do it.
So,
I'm down.
Cool. Well, I think today we kind of want to talk about, I think we're going to start from square one. Like, let's talk, basics of investing, or even like financial setup, or, let's just kind of go from ground one. What do you think the listeners want to know? Like, if you're a listener, what would you want to, what would be your question if you're brand new?
Kind of just where to start. So let's play hypothetical. Let's say that I'm making decent money.
Okay.
That, I'd say, let's say I have an extra $500 a month that, I'm saving and putting away, or whatever that case may be. Maybe it's a little less. Where do I start?
Yeah.
A lot of people pitch real estate and say, go do real estate.
Mm-hmm.
Is it real estate? Should it be something else? Like, where's a good place to start with investing?
Okay. That's a great question, and I have a lot of thoughts, but I want to kind of get more specific on and if we can keep it hypothetical. And I want to let's get a little specific on the hypothetical situation. When you say good money, how much would good money be?
So let's say I'm making 120 grand a year.
Okay. So 10 grand a month.
10 grand a month,
okay,
give or take. And in today's day and age, an average mortgage is probably 3,500 of that. Then you have insurance and kids or whatever else. So,
Yeah.
After everything, whether car payments and all that fun stuff, let's say, you've got roughly
500
500 to $1,000 max
Okay.
left over.
Okay.
And we're wanting to be, let's say that you're wanting to be a little more intentional with that money. So instead of spending it on McDonald's and going out to eat or whatever else, extracurriculars, that you want to be a little more intentional with investing.
Yep.
So do you start by just having a savings account and putting it away? And if so, how long do you have that? What do you want to see that built up to before you touch it? And different things like that.
Yeah. Okay. I love this. I think that's awesome. So 10 grand a month. The next thing, the first question I would say before we kind of even like went down the investing conversation, I'd be like, one is, what is your burn rate? It sounds like right now your burn rate is going to be about 9,500 if you only have 500 left over.
Right.
So it's like, okay. And that's what I think somebody should know. We're kind of assuming that they already know their burn rate, but I'm like, if your first step is you need to know how much you're spending every month and on what. So, I mean, 10 grand a month is a decent income. If you're saving $500 a month, that's going to be, what is that, like 5% of your annual income?
Right.
I would figure out how to get that a little bit higher. Either, and maybe I'm not the person to say like, you need to just go cut all your expenses, but I would look at it. I would like to see that number be like 20%. So if you could get up to 20% of your monthly income saved for investing or left over to start saving, which would put on a $10,000 a month, that'd be $2,000 that you can put aside every month. I know that seems like a lot. And so if you look at, let's say you figure out your burn rate and how much you're spending, and you're like, hey, we need this car, and we're being pretty frugal on stuff, and like this is just what our expenses are.
Right.
I would say start saving that $500, and I would say first maybe look at ways to like increase your earning capability, because like $500 a month saved is like, what is that, $6,000 a year? It's like,
it's not a ton.
It's not a ton, and it's gonna take a really long time. So if you can't cut on your expenses, we first probably should need to figure out how can you go earn more income. So could you, if you're employed by somebody, could you learn a new skill and get a raise? Or if you're not, if you're commissioned, like, what could you learn? What skill could you learn? What activities could you learn to increase your income? And then when you do increase your income, don't increase your lifestyle yet. So
I'd say that's the key, right? Because what I've noticed, especially in like, even when I say, oh my gosh, I want to start investing, the root reason for saying those words is I want to make more money.
Yeah.
Right. Like, yes, we all want to make more money passively and all that stuff, but I think the root when someone says that is they just want to make more money. So when you bring up the point of like, okay, like a lot of people get raises, a lot of people go find other ways to make more money, but then their lifestyle increases with that money.
Correct.
And they feel like they haven't made any progress whatsoever.
Correct.
So I think that's a huge first lesson or first step is find a way to increase money. You can even go DoorDash in the afternoons.
100%.
Make an extra $200 a day or whatever, however many days you want to do it.
Yep.
Just don't spend it.
But don't spend that money. Exactly. That's
a good
where
first step.
everybody like, it's like you go say increase your income, and then a new car comes when you get the income, and you're like, okay, that's you're not doing what you should be doing. So the goal is, because the first principle is like you have to have money left over every month. You have to have money left over every month that you can put aside. And $500 a month is great. I'm just saying it's going to be really slow. So like if your goal is to reach, you want to start investing quicker, you need to decide what's important. Like start figuring out how you can cut expenses and say, hey, we're going to live below our means. And if that means we need to sell the car and get a little beater upper to drive around town, if we need to, cut our eating out budget a little bit by another, because like even think if you could cut your eating out by $500 a month. I mean, I think a lot of people eat out a ton. It's like there's probably a couple $100 you could save a month there if you just shopped, and maybe you change where you shop and you could save a couple $100. Like if you could squeeze another 500 out, now you have $1,000 a month, and that's twice as fast. You're gonna be able to get there twice as fast. But I would say like a good number is like you should try to figure out how to get to 20% of what you're bringing in that you can set aside. So if you're making $120,000 a year, you should pay yourself first. Like take that 20% out first and be like, we have to figure out how to live on $8,000. no ifs, ands, or buts about it. We have that. You just have to act like that is your salary, and you have to figure out how to live on that.
People already do that with taxes, right?
Yeah,
So
yeah.
like people calculate their income after taxes. So
Yeah.
it's kind of just taking that same mentality and
100%.
calculating the income and the way you live after paying yourself.
Correct. There's a book called Automatic Millionaire, and that's like one of the principles they talk about in there is pay yourself first. Whatever you want to invest or save, do that first, and then figure out how to pay the bills and do everything.
Yeah.
But when it's always the afterthought, it's what do we make each month and what of our expenses and then what do we have left over? It's really hard. A lot of the times you just don't have anything left over.
Yeah.
And so you try to reframe that and get your monthly excess income that you could be saved to 20%. Okay. So let's say you do that. Let's say you figure out how to do that. You increase your income or you cut your expenses and you get to 20%. Your burn rate right now, let's say, is $8,000 if you're making $10,000. I would say the very first thing you need to do is you need to save 3 months at minimum.
Kind of like an emergency fund.
Emergency fund.
Dave Ramsey flow.
Yeah, and I'm not a Dave Ramsey guy, but there's an incredible peace of mind you get when you have 3 to 6 months of savings that you're not going to invest. I would put this 3 to 6 months of savings in a high yield savings account.
Okay.
So it's not just sitting in a bank account; it is earning some interest, and so it's not like just getting eaten up by inflation. But it is money that you're not planning to pull. You could also look at like liquid treasury, like pretty liquid treasury bills, like 3 to 6 month treasury bills or something like that, if you wanted to put it in there, if that was a better return. But find a very safe place to store it that is pretty liquid for you. And just having that is going to give you a ton of peace of mind. Like having the 3 to 6 months is I think there was a stat that was like people that have 3 to 6 months worth of savings have better peace of mind than people that make $200,000 a year.
That's interesting.
So a guy that's making $50,000 a year has the impact of saving 3 to 6 months worth of money, like their burn, gives them more peace than if they were just to go make $200,000 a year. So because exactly what we've talked about is like when you go make $200,000 a year, you easily just start spending $200,000 a year. So
Right,
it's like,
right.
you know, anyway, so that would be my first step. Figure out how to, get to 20% of your income saved each month. Then it would go save 3 to 6 months worth of your burn rate. So the nice thing too is like if you cut down your burn rate when you're doing this, your 3 to 6 months worth of savings is also going to be a little bit, it's going to, be quicker to get to because you're like, hey, we don't burn through as much.
Right.
And then once you have that, then I would start looking at just building an investment account. I call it like your war chest. This is like money that you have your 6 months worth of savings, 3 to 6 months worth of savings. So you're good if anything like really hits the fan. Car repair comes up or whatever, and you need money, you've got that. But then you start putting that extra money into what you want to go invest with. And I would say like for this, if let's say you're putting away $2,000 a month, or $1,000 a month, it's not enough. It's going to take a while to start investing in real estate because you need a down payment and stuff like that. And so I would start investing into the stock market, ETFs, or look at like companies that you think are going to see some growth. And what I like to do with stocks is you can go buy the S&P 500. That's pretty conservative. And I would give different advice. Like for this hypothetical situation, we should probably know age. Like we're going to assume this one's a young individual.
Yeah. Let's assume they're young. And then again, let's assume that like, this money is very, very, very important to them.
Yeah.
Right. Like
yeah.
it would be extremely important to me. Like you've spent 6 months to a year saving this up.
Yep.
Where do I put it to,
Yeah.
there's never a guarantee in investing. So I don't want to say guarantee, but
Yeah.
would give me the most comfort knowing that it's going to make some money for me
Yeah.
and start me on the track and the road
Yep.
to investing. And you're saying stock market.
Yeah.
Okay.
Stock, because you can get in, because you look at, you're not messing with the money that you've taken so long to save, the 6 months. Like that's just going for peace of mind. Now you feel like you've got the flexibility. You know that each month now you're going to have $1,000 extra that can go somewhere, $2,000 extra that can go somewhere in this situation. So you're 20% of your income, like $2,000 a month, you're not going to feel as bad if you put that in the stock market and like first month it goes down a little bit because next month you have another 2,000 to put in and you can cost average. Like if it went down, well, if you're going to buy that stock again, it's at a cheaper price, So like getting that mentality of like, it's okay. This isn't a get quick rich thing. It is a constant thing that you're going to be doing every single month. and having that peace of mind of, hey, this is a long play, I think is important too. So, but I would say like, look at, if this is a young individual, I'd probably put a little bit more risk on. So I would say like, look at companies that are important to our current economy and decide where you think there's some future growth. Like I'm really like right now I'd be really bullish on, because I think you can get a good return. I think they're pretty safe, but like companies like, I'm going to say like NVIDIA, for example, like chances are like maybe it's a little overvalued right now. Maybe it could come down. It's come down a little bit over the past few months, but like that is a company that with the AI revolution, everything that's coming up, it's like they're going to be a player. So it's a pretty safe place to go. You could also just hedge and just, buy the S&P 500 ETF and just follow the S&P 500. Usually you're going to get like a 10% return, 9% return a year on that. But just be putting your money away in a place that's going to get you a little bit better return than a high yield savings. And again, you're going to want to get this number to like, let's say like before you can really do anything with it, if you want to get into real estate, it's like you're going to want that number to be close to like 50 grand or so. So I would be doing that, putting it away in there, start seeing the returns there. And hopefully like some of these companies, it's crazy. If you actually look at like, if you would have invested in Tesla or NVIDIA or any of these companies like 5 years ago, dude, their percent increase is like a few %1,000%. So like it could be, that number could drastically change in a 3-year period. But let's say you just get your average, you're 9%. Then I would say once you have that built up enough for, you want to start looking at a real estate investment. Or like, depending on the market, like you want to maybe do like a hard money loan in a real estate project. The game of investing is really just where can you get the best return on your money? So like if you're getting a great return in the stock market, like we go on a bull run and you're making 15+% a year on your money, it's like you should be really happy with that actually. Like that's a great return. If you're looking at a real estate project or a real estate investment, all you're looking at is your cash on cash return. So when you invest into a rental property, everybody wants to buy rental properties. That's a hot topic. And I like buying rental properties, but I don't always think it's the best investment. Right. Like it's got to make sense. So when I look at a rental property, I look at, okay, if I'm going to put $50,000 down on this property, right now I'm getting in the stock market, I'm getting a 9% return. So I should be getting a better return than the 9% that my money's making. And so when you go into a real estate project, your cash on cash return is really just going to be after your expenses. How much money are you making on that 50 grand? So let's run an example of, so on 50 grand to get a 10% return, you'd want $500 a month after all your expenses. So if I buy a property and I put the 50 grand down and my monthly payment is $1,500 a month, I need to be making over $2,000 a month in rent for me to net that $500 plus dollars a month. And when you're doing that, you got to like calculate some, there's a great calculator a buddy of ours made, CDS rental calculator that you can get in the App Store. It's Chandler David Smith's rental calculator, and he owns a ton of units. But I use that a lot. Like go in there because it'll give you your cash on cash return, and you'll put in like if you want to manage a property, then you won't have a management fee. But if you want to hire a property manager to do it, you need to put in the property management fee. You need to have taxes and insurance in there. You need to have some estimate on like repairs. A lot of people just look at the rent. They're like, oh dude, my monthly payment's $1,500 and I can rent it for $2,000 a month. That's $500 a month. It's like, well, not quite. Cause you're not including maintenance. Right. You're not including like your management costs. You're not including any vacancy. And we run a property management company. Like you're going to have some vacancy regardless, even if the market's hot, like you're going to have either a few weeks here or a month that it's vacant, and you're going to eat that full payment. So that's going to affect your return on your capital. So like you've got to run the actual numbers on that deal to make sure that it is going to make you more than what you're making in the stock market. Because if it's not, leave your money in the stock market. The game is put your money wherever it's going to make you the most money.
So my question, because to reel it back in, I'm going to really force you to dumb this down.
Okay.
So like when mentioning like the stock market and stuff, you're mentioning things like hedging, ETFs, S&P 500, like all of these things. So let's dumb it down to like, okay, let's say I hypothetically know nothing about the stock market. Okay. I've got this excess money. I've saved the 3 months.
Yep.
I want to start putting money away.
Yep.
Do I go to an Edward Jones and say, hey, I'm going to start giving you this
Yeah.
because I don't know anything about the stock market.
Yeah. Yeah.
Like the stock market sounds great.
Uh-huh.
It sounds like a good investment, but I don't know where to put it. I don't know which company is going to be the best. I
Yeah.
don't know how to even run the platform of the stock market
Yeah.
to deposit my money.
Yeah.
Do I now have to go learn all that in order to be able
That's a
to
great
invest?
question.
Or do
Yeah.
I give it to like an Edward Jones or a financial institution to do
Yeah.
it for me?
That is a great question. Here's my thoughts. So, and I got to be careful here because my father-in-law is actually a financial advisor for Edward Jones. So that's
I
funny.
didn't know that. Like I was like,
It's funny because
preface that.
I do have some money with Edward Jones, but what I have him manage is like our retirement accounts.
Okay.
So I have him manage like our simple IRAs. You know, if you have retirement accounts, you can self-direct retirement accounts. Like you can have a self-directed IRA and all that. But I would say for retirement accounts, like you can go use like a Edward Jones or a financial advisor. For your personal investing, because we're kind of talking more of like, hey, this is stuff. Most people are going to have retirement accounts through their employer, and their employer is going to have that managed wherever. And
Correct.
usually you're going to have like a target fund that's going to go for, and you're going to base it off your retirement age. And like, hey, this is a target fund that for 2050 when I plan to retire. And all a target fund is, we'll sidetrack on this. If you don't know and you have an employer retirement account, a target fund is basically like, if you are young and you aren't going to retire till like 2050, you click that as your target for the retirement fund. It's just going to slowly get less aggressive. So it's going to be like, oh, you've got 20 years in the stock market. Like we're going to get more aggressive, and then slowly they're going to balance out that fund. So it's not as aggressive and volatile towards the end of your retirement. So and then vice versa, if it's an older person at that company and they're going to retire in the next 10 years, they're going to click that fund target date, and it's going to be probably less aggressive than a younger individuals for the same company. Anyway, so that's how those target, if you have it, because I remember when I first worked for Wells Fargo, I set up my 401k and stuff with them, and I'm like, dude, it was so over my head. And they're like, yeah, just put it in, select a target fund. I'm like, well, what is a target fund?
Right.
Like, do I not, what is this all about? Do I not see the money till 2050? Like, what is this? And no, it's just, it's the way that's going to invest for you. But so retirement accounts, that stuff, I would say, yeah, go talk to an advisor and get your retirement account set up and talk, how to do that. When it's personal investing, this is where I'm going to like, the best investors, the best hedge fund managers in the world, like, I think they averaged a 13% return. And by hedge fund managers, like these guys are investing in like new companies, and, they have early access to stuff, and they're going to tell you like, oh, we're returning X amount. But over like a 30-year period, the best investors, I think Warren Buffett said this, over a 30-year period, you look at the best hedge fund managers in the world, like they averaged a 13.3 or 5% return on money. So you're like, if you can just go into the S&P 500 and that average return over that same period of time was like 11%, it's like, that's probably your safest bet, because you get some of those financial advisors that they'll guide you into, some risky stocks. And you might like the reason that some of those investors, like they hit 20% return some years, but then they totally bomb it when a company bombs it. So like, if you just want to get a piece of the S&P 500 is just, you're buying a share of the top 500 US companies. So it's like, you're not individually buying Apple, Tesla, all this stuff. You're
Getting a piece of all of it.
Getting a piece of all of it. So it's like, if some of them go down, cool. It's like you have 490 others that are still stable. So it's a very safe investment, the S&P. So if you wanted to do, like, you can go to Robinhood. I would download a Robinhood account. I would put the money in there, and I would personally just start doing it yourself, because like the fees when you're doing it yourself are so minimal. It's so easy to set up nowadays. You can trade on your phone. It's like very self-explanatory on how to do it. I would say watch a YouTube video and figure out how to set up a Robinhood account and start just investing on your own. Now, if you inherited a big chunk of money, yes, go talk to an advisor if you don't know anything. But if in our situation, we're talking young individual, doesn't sound like they really have any.
Let's say it's like newlywed, just wanting.
Yeah.
It's Kyle.
It's Kyle. Okay. Newlywed. He just got married last month.
And I know that, like, I guess I'll say this too. I know a lot
month.
of our listeners are probably going to be a little bit more like educated on this type of stuff.
Yeah.
So I don't want to push them away by getting too dumbed down on this.
For sure.
But just trying to play devil's advocate and saying, okay, most people put off that they know more than what they actually do.
100%.
They really do.
100%.
They act and talk and act, that they know more than what they do. So I want to dumb this down so that people like that and myself that want to learn to get this know where to start and how to do it and how much effort and time and knowledge might be required to do it.
Yep.
So I like what you said as far as like, okay, go download a Robinhood app.
Yeah.
It's going to tell you how to do things. It's going to be really easy.
Mm-hmm.
And I can attest to that. Like, I have a Robinhood app and use that for investing.
Super self-explanatory.
It's super easy. If Jace can do it, anybody can do it, right? And so I really like that. I think that's super smart and a great first step.
Yeah. So do that. And depending on your risk tolerance, like you could get crazy with it. And if you want, like for me, my personality would be like, I'm going to do this. And I never buy like the S&P 500. I'm a little risky. I like to, I play poker. I like to gamble a little bit. And I've gotten burnt. Like I've actually jumped into things way before I understood how to do it. And it's cost me. And so like, I would say take the time, don't get FOMO. That's another thing. Like people nowadays, when they're investing in the stock markets or crypto, they're like, oh man, I missed out on this. And my buddy said Doge is going to the moon. And so I'm going to put all my savings into Doge. It's like, don't do that.
Right.
Really look in, I would say if you're going to personally invest, either one, if you don't want to do research, then you need to buy an ETF in a fund like the S&P 500 ETF or another kind of mutual fund that's a conglomerate of top companies. Because that's like, you can just have that on autopilot. You can actually set it up so like it auto pulls from your bank account, whatever amount you want each month, and it auto buys that one stock for you. That's just safe. Or if you want to like maybe say like, I want half of my $2,000 that's going in, I want half of it to go no save something stable like that, like the S&P. And then I want the other half to go towards something a little bit more risky because I'm young and I'd rather chase a bigger upside. Because it's like if you had invested in the S&P 500, you would have averaged whatever 12% return over the last 10 years. If you had invested into Tesla, you would have gotten like a 20,000% return.
Right.
So like it's just such a
Wild.
like you should take some big swings,
right?
Because I think it is so beneficial if you can hit some of those. But I don't go gung ho and put everything in there. So like
don't save for a year and have your 6,000 and then go put the 6,000 into Tesla.
No, and that's the other benefit about doing it every single month,
right?
Because that's what people get confused too. They're like, I need a lot of money to start investing. And they go save that 6,000
right.
And they put it in. And then that month the stock market goes down and they're like, F this, I'm never investing again. Like this is bull crap. I saved so long for that. When you're doing it on a monthly basis, it's called cost averaging because if let's say the stock goes up, cool. Well, you're still buying it again that month and you're buying it at a higher price. And if the stock goes down, cool, you're still buying it again that month and you're buying it at a lower price. So it lowers your risk. Like your portfolio has, let's just say 100 shares that you bought for $100 and then another 100 shares that you just bought for $90. So now your average is like you have 200 shares for $95. So you have less. So anyway, and when you can just do it consistently, you say, hey, this is what we're doing. And I would say like, you're going to probably do that. If you have $2,000 that you can spend a month, it's like, you're going to probably do that for 6 months, 6 to 12 months before you're really going to have any money in there. And I would just plan to probably do it for a year,
Right.
And then once you understand, you're like, okay, I've got a decent amount here. You do have to learn to do like that is probably the easiest and most passive way to invest is the stock market. There's no easier way. Everybody can do it. Everybody should do it. That's like, you can call yourself an investor if you're just investing in the stock market. Now, the other shiny things like real estate are great, and they're great for different reasons. But you still want to have a good return on your capital when you're getting into real estate. I see so many people that they don't understand the stock market and they don't want to learn about it. So they just immediately just start saving money. They're like, I'm going to go invest in real estate because, 90% of millionaires were made in real estate. It's like, well, okay, I mean, cool, but you need to understand real estate because like I have seen a lot of people buy bad deals that make really no return on their capital, and your money would be way better off just being in the S&P 500.
Right.
Like you should just do that. So when you have this investor hat on, I know, and I've repeated this, like your biggest thing to understand is the goal of an investor is to you have leftover capital each month that you can invest. And the goal is to invest in the highest ROI opportunity with that capital. And that ROI is going to change. The stock market's down and real estate, there's deals in real estate, like you should go into real estate. There's also like right now we do a lot of hard money lending because it is hard to buy a rental property and make it cash flow with a good cash on cash return.
Right.
And I'm not the kind of guy that's going to go buy a cat. Like, I'm not going to go, if the cash on cash return is like 5%, I'm not jazzed about it. And everybody's like, well, you know, you get cost savings on your taxes and principal pay down. And it's like, yeah, you do. But like, is that really more beneficial than doubling your return in the stock market and having like zero? Because even if you, let's say your estimated return on the investment for real estate is 5% cash on cash return, and then a water heater goes out.
Yeah.
And erases your return for the next 2 years. Like, people don't understand the risk with that. I'm like, that's not, like, you're better off just doing that. So don't get this shiny object syndrome where you're like, oh, I had a buddy that killed it in real estate and I want to invest in real estate. It's like, you can make really good money investing in real estate, but you have to understand that investment. And so, like, talk to an expert. If you've never done a real estate deal, there's not a Robinhood for real estate deals. Like, you can't just download this platform that's going to give you good real estate deals. You actually should go talk to a mentor for real estate. Like, you should talk to somebody that has invested into real estate. You should talk to, you could interview real estate agents, but not every real estate agent knows or has invested in real estate themselves. Right. So, like, ask them about that, or ask them if they have somebody that they know that can help guide them. Because the last thing you want to do is, I'm a real estate agent, and I'm going to tell you, like, when a real estate agent works with an investor, if it's a new real estate agent and they've never invested in themselves, everything's going to look like a good deal. Everything's going to rent out for a 10% cash on cash return.
I've had a couple people, like, this is hilarious. They'll tell me, like, they know when a real estate agent's like hurting a little bit for money. Yeah. Because they'll start sending them random stuff and saying, this is a great deal. This is a great deal. Yeah. And then they'll crunch the numbers and be like, this is awful.
This is a terrible deal.
It's a terrible deal. Why are you sending this to me?
Well, just it's like, it's the uneducation. And to be completely honest, like, if it's a good deal, me as I'm buying it.
Right.
So it's like, if it really is that good of a deal, they're probably not sending it to you. Like, they're probably going to buy it. So, but with that, it's like, you can have a good agent that can represent you and show you, one, how to make a good deal. And obviously, like, I say that, but I can't buy every deal. Right. So I will, like, if there is a good deal that right now I'm actually really low on capital because we just bought a bunch of houses and we're buying some storage units if Jace can ever put the deal together. So it's like, some days you are going to be low on capital. And so it's like, you will pass those deals on. And so it's good to have a good real estate agent that is looking for deals, understands how to accurately calculate deals. One thing, like, wholesalers, this is a side tangent. If you're ever looking to invest in real estate and you want to, like, flip houses, we flip houses. And a lot of the times you're going to talk to wholesalers because wholesalers get these houses and they're going to tell you, because they send them out to, like, investors. They'll send out the deal and they'll be like, hey, yeah, you know, it's going to take $30,000 to renovate. Always double it. Whatever a wholesaler tells you is renovation costs, they're way off. And then they're going to tell you ARV is 300, plan on like 270. Like, they
always hype it up.
Always hype it up. Yeah, you can renovate this thing for $15,000. I'm like, there's no effing way.
Yeah, and get your paint.
They're like, and you ARV on this thing's 300. I'm like, dude, I sell houses all day. There's no way you're selling that for 300.
Right.
But they get new and excited investors. They're like, they don't know because they're not actively in the real estate space. They're like, oh yeah, he said ARV's 300 and you can probably renovate this for $15,000. There's a $40,000 spread on this deal. Like, I'm gonna go flip it. And then they get into it and it's like, dude, hard money costs, renovation costs were higher. Market isn't what they thought, and it sells, and they've got to give closing costs and commissions, and then they've got to negotiate on repair items through the RE10, and then all the profit's gone.
Right.
All the assumed profit's gone. And so don't ever go do your first project alone. I would say, like, partner with somebody if you want to get into a real estate deal, or go find a mentor that can help you find a good deal. And then the other thing is, like, hard money lending. So hard money lending is something that we have done and we also use when we're flipping houses. And that's a great return. So when I talk about my money, like, I like to have it in the stock market doing stuff, or if I can lend it out. Lending terms, usually, like here locally in Idaho Falls, I know this is different around the area, but like usually you can get a hard money, if you're going to do a hard money loan, like 12% interest and 2% origination points is like a standard fee for hard money. And all that is like, I'm earning 12% on my money each month that it's out, 1% a month. It's 12% annually on the money. But every time I just for originating the loan, I charge a 2% origination fee, so I get 2% on my money right up front for just originating the loan. So essentially, And I usually do those loans for 6 months period, a 6 month period. So essentially if I can, that's a 14% return annually. Really, if I do 2 deals, it's 12% over the year. Plus I do a 2% origination for 6 months, and then I can originate another one in another 6 months or extend that one. Sometimes that happens, like they need it for another 6 months because they didn't do it as fast as they thought. So I do another 2% origination for another 6 months. If I do that, that's a 16% return on my money. Mm-hmm. That's incredible. Like, I cannot find a rental property right now that'll return me 16% on my money. And I can't, right now the stock market on average isn't giving me 16%. So it's a game of, when you're investing, is like, where can you get the highest ROI? And you don't have to play that game. Like, if you're just like, I just want to save up some money and invest it, it's like, just put it in the stock market and start making some money and having some wealth building going on.
Right.
The game is like, just figure out how to not spend all your money so you can have some money left over so that you can start investing. Because you don't have to, not everybody wants to chase the highest return. It's a game to me. Mm-hmm. Like, I am always looking at, if I want to, I've spent so much time working to create this blanket of money, or this pile of money. Where can I put it that it's going to give me the best return? Because that money, it's like, I already worked for it. Now that money's working for me. And if it can spit off a few $1,000s a month, that's awesome. And I can use that money, that I don't have to touch that principal on the investment. I just get to use the interest or income that it makes. And I can go buy a car and have a car payment if I want. I can go buy a boat. I can go buy whatever. And so the goal should always be like, live off of the interest income you make from your investments, and never like the principal.
Here's what I like about what you said, and kind of what's come to my mind. So, like, you read and hear about all these people, like, I'm going to throw random names out, like Dave Ramsey, Robert Kiyosaki, Grant Cardone, like all this stuff, right? Mm-hmm. They go and they talk kind of like how you have, and starting to invest, or what to do, and, where to look.
Yeah.
One thing I find interesting is like, the biggest thing that you said is find someone to go and partner with. And I think that's crucial. Mm-hmm. So, like, step one, don't spend all your money as you make more. Go find a way to make a little more money. There's a million ways to do that.
Yep.
The key is just don't spend every dime that you make.
Yes.
Then step two, stock market. Those things you can do on your own.
Step two, savings.
Savings. Yeah.
Get 3 to 6 months savings.
Then the stock market.
Yeah. Yep.
In a year and a half, 2 years, that's something you can accomplish on your own.
Yep.
Starting from day one. Once you want to get into like real estate and stuff, I really, really like that you said maybe find someone to partner with.
100%.
That's going to eliminate a ton of your risk versus you trying to go in all on your own. Because let's say that you want to look into a property that's going to take $50,000, as a down payment.
Yep.
And it's very minimal in most real estate transactions.
Yep.
You're going to need more, but I'm going to use $50,000 as a key. You're not going to have that on your own.
Yeah.
And if you have worked your butt off for the past 5 years to save up that $50,000, you don't want to risk that all just to throw it in there. And
you put it into one deal,
your
first deal, and it doesn't turn out how you want.
You just wasted 6 years plus or whatever, right, of investing. So find someone that knows what the crap they're doing.
Yep.
And go in on it with them.
Yeah.
Partner with them. And I can attest to that. Like, I've done a wholesale deal. It was not alone. Mm-hmm. Like, it was with people that knew what they were doing.
Yep.
And it worked out. Now, most people want to make all the money in the world.
Correct.
And they're like, oh, I'm only getting a small piece of the pie.
Yeah.
Congratulations, you just got paid education.
Yes.
Like, you just learned how to do something.
And made money.
And made money doing it. Yep. Like, you've got to be okay with that.
100%.
So I love that. I loved that advice there.
Yeah.
I think that was key.
Yeah. I think you should always look at how are ways to mitigate risk.
Right.
Because that's the other side of investing, is where can I get the best return, but also how do I mitigate risk? Mm-hmm. So when I look at an investment, I learned this early on. Like, I invested in some real estate developments that, like, I didn't mitigate risk very well. And the spreadsheet looks good and the return looked good. And then 3 years later didn't look good.
Right.
When it all shook out. And it's like, awesome. But you learn those things. And because I didn't have, it was my first project. I didn't talk to other people that had invested in developments. I didn't say, and I should have said, like, hey, can you analyze this deal with me? I don't know what I'm looking for. Mm-hmm. I didn't know what red flags to look at. I didn't know even like the operating agreements, like I didn't know what I should or shouldn't be looking for. It just like sounded good. And so I probably could have saved a lot of money and without having to learn that painful lesson if I just talked to somebody or found a mentor and been like, hey, you've invested in real estate development deals before. Like, what are things I should look out for? And hey, if I send you this pitch deck and this spreadsheet, can you see what are your thoughts on it? Like, swallow your pride and just ask for help. I think
Because
is
if
like,
you don't, you're just not going to do it.
correct. You're not going to do it.
You're going to get
or you're going to
bent
get
when
bent.
You try to do it yourself.
It's so like for anybody out there too, like I am an open book. I look at deals for people all the time. Even people that are way ahead of me because they're different. Like there's people that have a ton of doors, but they've never invested in a real estate development or they've never done a subject to deal or they've, whatever. So they'll send me deals and be like, hey, or like I had a buddy that bought a hotel and he's like, sent me the P&L and just like, hey, can you look at these P&Ls? Like, what do you think? I'm happy to be a resource. If it's something that I've done, I'm happy to give feedback on it. If it's something that I haven't done, I'll try to find somebody that has done it to help you. But, like that's such a crucial part is like mitigate risk, figure out how to do that. One example is like, there's actually a listener on this podcast who's a young kid, he's been working his butt off, working for like a hospital in the medical field. And, he had saved up like 60 grand. And he's like, dude, I don't know what to do with this money. Like living very frugal under his means, taking him a few years to save all this money up. He's still renting a house with his brother, but making good money. And he'd save this up and he's like, dude, I want to invest in real estate. And I had a very honest conversation with him. I mean, I'm a real estate agent. I could have said like, dude, let's get you a rental property and made a commission on, getting him a rental property. But I was like,
some financial interest.
Yeah, there's some financial interest, and, but I didn't. I said, dude, if I were you, like I wouldn't buy a property right now. Like you should not spend that 60 grand to go make $100 to $200 a month. In given this given his situation,
right.
There is other people in a situation where it's like, dude, if you're making $500,000 a year, you're going to probably have a pretty hefty tax bill. And it might make sense to go buy like a really non-cash flowing rental property or a break-even property. You could probably even lose money on the property. And it's still going to make sense for you because you are going to get the cost savings on taxes. Because if you do a cost segregation study and you could do some bonus depreciation, and we can get into like,
but
that's another episode.
That's advanced stuff. That's like when Jace, that's a year from now.
We'll get to that conversation. But I'm like, people look at people that do that and they're like, well, he's buying these properties and doing that. And I'm like, well, you got to understand that everybody's situation is different.
Right.
And that's why you have to have the context. It's like, if you're making $120,000 a year, that's good money, but like you're not really going to have a huge tax bill. Right. Like it's not enough to go make it worth buying a non-cash flowing asset for tax savings and depreciation and principal pay down. It just doesn't make sense. Now, if you're in a higher income tax bracket, like it totally could make sense. Like this year I bought a non-cash flowing one. It's pretty much a break even property that was really expensive. And a one that I lose like $200 a month on. But the only reason I do that is because I am going to cost segregate them, take the tax depreciation, and save a lot on my income tax. Right. And because I'm a real estate professional, I directly get to take it off of my active income. So it's another benefit. But so there are situations where it does make sense, but I would never advise somebody, in that situation when he came to talk to me, it's like, yeah, you're making good money and stuff and you've worked really hard for this, but I wouldn't invest in real estate. The one thing I talked to him, he's like, well, what about flipping properties? I was like, you could flip a property. And I love that strategy when you have 50 to 60 grand, because you probably have enough to put that 20% down to get the hard money loan for the rest of the purchase. But my next question to him, like, do you have time to flip the property? Right. Well, he's working 12 hours a day at the hospital. And then he does 1099 work for another hospital. His 2 or 3 days off that he has, he's working like 7 days a week, and he doesn't have time to like manage a flip or do that kind of project. And the other thing was like, okay, well, do you have somebody that could manage a project for you that you could split it with and stuff? And it's like, well, no. And so my next thing was like, well, have you ever, like, I talked to him a little bit about hard money lending. Like, here's a good option. It's called like a hard money loan. Like, you'll be in a first position lien on a property with somebody. And there's ways to do this. Like, technically he had such a low amount that it's really hard. Like, he couldn't do a full hard money loan. Right. So I had him partner with me on one. There was another flipper that needed a hard money loan, and I was going to fund it. And I said, well, if you want to fund part of it too, I can let you in on it. Here's how it works. You get X amount of points on origination and X amount return on the money. And it actually ended up like, again, this was supposed to be a 6-month investment. He put his 60 grand in, and the flipper was a little over ambitious. It was he was newer to the deal, and took way longer than he thought, cost way more than he thought, and had a lot of trouble selling it. And so we actually ended up, what was supposed to be a 6-month turnaround, 120 days turned into like 330 days, almost a full year.
Almost a year. Wow.
But we charged every time we needed to extend, we charged more origination points. And then the entire time that our money was out, we were getting interest on the money. And the reason I'm comfortable, like I would never tell somebody to just go do a hard money loan either, if you don't know it. The reason I was comfortable with, I told him and I let him partner with me on it, because there are some risks with hard money loans. If he didn't make his payments or he stopped the project, our protection is that we'd foreclose on the property. Well, now we have a property that needs finished and sold. Well, when he partners with me on it, it's like, well, I have the experience flipping this. Like it's a really low risk to me, because best case scenario, like I foreclose on the property,
You fix
we
it
keep
up,
their
turn
down
around,
payment,
sell
and then
it.
I fix it up, turn around, and I get the margin there.
Right.
And I always make sure when I'm doing a hard money loan that like there is margin to be had if I did have to foreclose. Again, he wouldn't know that because he doesn't know, he's not in the real estate deal all the time. He wouldn't know exactly what to invest in. He wouldn't know all that stuff. Anyway, so we did it. He finally got paid off, and he was really cool, like young kid. And I was like, man, he's probably gonna be mad that we keep extending. He thought he was gonna be out for 6 months, but he loved it. He's like, we're making money. And I remember the day he got it, like we closed, the funds got wired back to his account. Now he had, I don't even remember, it was like 70, almost close to 75,000. And, it was like, he's like, dude, this has been awesome. Like, let me know when there's another project. I want to invest again. Like now he's hooked. He wanted to keep doing this because he saw, that those 330 days are going to go by no matter what.
Right.
He could either have his money in what he had in his bank account doing nothing, and in 330 days he would still have 65,000, or he could put it to work for him, and while he's out doing his thing, still saving money, working hard, he looks back and now he's got that money is turned into 75,000. And it's like, dude, that's cool. Like now I didn't do anything and I made an extra 15 grand this year. Or your alternatives, you go spend it. So it's either it sits in the bank account, or you go spend it, or you invest it. Those are your 3 options. There's really nothing else to do with money.
Right.
So your 3 options. So you got to choose, like, what are you going to do with your money? And I'm glad as a young individual, like he didn't go spend it. He could have went and bought a new car, but he didn't. He set it aside and he let it grow for him. And I'm excited to see, like, if he does that continually, like what that could turn into. If you do the math, like if you're ever like questioning, is it worth investing? The beginning stages of investing are really hard because it is such a small return. If you have $1,000, $2,000, it's I'm gonna jab Jay's here.
Do it.
It's it's hard to say, like, instead of buying new golf clubs for $2,000, if you put that into a Robinhood account, it's like, well, it's really not going to return that much.
Yeah, I'm gonna make $20.
Yeah, so it's not exciting,
Right.
But it is. As soon as it starts compounding, the exciting part is when you have more money, but you will never get to more money if you don't start. You'll never reap that reward if you don't start. So once you get to, you've got $100,000 in there and you're making a 15% return, that's 15 grand a year. That's over $1,000 a month that comes in with you doing nothing. And then it's like, well, then when you have that thing going, it's like, if you want new $2,000 golf clubs, it's like, well, in 2 months, just my interest income off of this is going to pay for new golf clubs.
Right.
And then another 2 months, I could get no more golf clubs, and I'd still never hurting that principle. That's like you're working towards having a nest egg that is going to help you live your life more comfortably. And you've just got to forego, like, the exponential number on that is insane. Once you, like, if you just got a 15% return a year or 10% return a year, and you scale that over a 25-year period, the compounding number on that is insane. Like, it quickly turns from 2,000, 10,000, 50,000 to 150,000 to 600,000 to $1 million. And then it's like in 20 years when you're, if you're young and you start doing this, you're 40 something and you've got $1 million in assets that's printing off 10% return. At $1 million, 10% is 100 grand a year. It's 10 grand a month. That in this situation would replace your income. So, like, that's, you gotta have the end goal in mind. And I think our generation especially is we're so short-term focused. It's immediate gratification. And I struggle with this too. Like, this is actually, I fight my own head about this, because if you ask my buddy Austin, who helps us with our finances, and I'm going to say this too, don't feel like you have to do this alone. Like, go find somebody, go find a friend, go find a family member, like find somebody that you can talk finances with. Because I think that makes the journey so much easier when you have somebody you can talk to and get advice from. And even for me, like, I think I'm pretty savvy. We've done pretty well, but I have a buddy that he's got his finance and accounting degree, and that's like what he does. He loves spreadsheets and he loves budgeting, and I hate budgeting. But even like he helps me with ours, and like he holds me accountable. Like we do like a budget meeting together, and like anyway, we're really good friends. So that's how close we are. But he'll even tell me, he's like, dude, like our spending habits are so much different. I burn way more capital. But he'll say like, but I don't think it's outrageous. Like, what you're doing isn't outrageous. And I have a way where like I still save money, but like I am a big proponent of, I could die tomorrow, right, and I want to live. So like I do want to go on nice vacations still. I want to do that. There is a balance, and you got to figure out what balance you're okay with. And that's where I say, like, you could get to 20% a month of your active income that you're saving. It could be less. It could be more. There's some people that try to live off of they try to invest 60% of their income and live off of 40. And it's like, it depends on how frugal you want to be and how important it is for you to how important it is for you to get to financial freedom, because investing is the only way to financial freedom. And so you got to figure out how important is it to you, and at what age or what point do you want to reach that number, and work backwards. It's like, if you want to be financially free by 40, how much money? It's really easy. It's like, how much money do you need to be bringing in to be financially free? I need 10 grand a month. Okay. Well, if you say that your investments are going to peel off 10%, are going to make you 10% a year, how much do you need to be making 100 grand without touching your principal? It's like, you need $1 million. Okay. So you need to get to $1 million saved and invested. And it's like, you don't have to save that full $1 million, because it's going to take you a few years, and that money that you're investing is going to compound over time. And so like, you personally might only save 200 grand, but because you've been investing it over a 10-year period, it has turned into $1 million.
Right.
Okay. So that anyway. And so I would say, look at an investment calculator and like just put in, if I invest $1,000 a month and I do it for 20 years, and I get on my money, I get a 10% return compounded. Like, what does that number look like?
Put that into ChatGPT.
Yeah, put it
out in 2 seconds.
100%. Put that into ChatGPT. Like, literally, if I invest $1,000, put this case. Actually, let's do it right now. That's actually great. I forgot we have ChatGPT that can give us immediate feedback.
Immediate
Say,
gratification.
if I invest, let's use our scenario, $2,000 a month and get a 10% return compounded, 10% annual return compounded over, let's say, 20 years. Boom. So if you invest $2,000 a month for 20 years and earn a 10% annual return compounded, here's how much you would have at the end. $1.376 million.
In 20 years.
Mm-hmm. $1.3 million.
And the cool thing about that is that like a lot can happen in 20 years when it comes to like your career, whatever that, like you might change careers, whatever the case may be. So that is just based off of your current state, trying to save 10 to 20% and investing it. Mm. That doesn't account for if you got a raise and kept that 20%, or if you inherited something and all of that. Like that is literally just based off the current situation that you're at right now over the course of 20 years.
Yes.
If you can just maintain, I think the key here is the habit of investing the 10 to 20%.
Correct.
Of whatever you're making.
Yes.
So that as it continues to grow, because it will, as you get better in your field or whatever career you choose, you're going to make more money.
Yep.
Keep that 10 to 20%. And that 1.7 or whatever it was, 1.3 is easily going to be 3 million.
Yeah.
Easily.
And
in
that's
my opinion.
Yeah, and that's like a 10% return. And that's like what gets me excited about having capital and investing is like, that's what that could do. But like a 10% return is like, man, that should be like, that's average.
Right.
If you're investing. Now, when you have capital, you get the best deals. Mm-hmm. So deals go to people that have cash. So when you have cash, or you have cash on the sidelines that's invested that you could liquidate, you can sell stocks, and you can also get lines of credit in stocks. But
huge rabbit hole.
Yeah, but you could take that money, like let's say a real estate deal. I'm going to use let's say you do want to get into real estate. Mm-hmm. Well, the best way to get into real estate, I think initially, is like you can flip a house, and that right now it's really hard to buy just a rental property. You should buy a fixer upper that you could renovate and rent. Anyway, those deals, when people need, like they're in a tight situation, cash is king. Like you can go get a deal 70% of market value. So basically you're getting like 30% off if you have cash. You can, if somebody, you just get the deals when you have cash, if that makes sense. I look at some of my buddies that have invested in real estate, and it's like they get a lot of off-market deals, and they get off-market deals because people know they have capital. So when they're in a tight situation, or they know somebody, or they're like, even agents, if agents are like, hey, this is going to be really hard to sell on the market because it needs so much work. It's not going to get approved for conventional or FHA financing. They're going to have to go find a cash buyer for that deal. So they're going to go to people that they know have cash. So when people know you have cash and they know you're invested, and you're going to get amazing deals. And sometimes like deals that I've just gotten because I've had capital, I mean, those deals I've made sometimes 2 times on like I've doubled my money. I bought it, renovated it, whatever, doubled my money. And it's like, so if you can also have capital, and then you can go and every once in a while take a hit where you get a home run deal because you have capital, that's where you like, that number just becomes crazy.
Yeah, that 1.3 is just based off of you
just putting in the S&P 500.
Putting in the S&P 500. That does not count
all of the
for all the other
potential
stuff that you could do with cash.
Yes. So, but the only way you get that is if you have cash. And that's why it's like, it is so important to start investing and start saving. Mm-hmm. Like I look at, we would be absolutely nowhere near where we're at today if we hadn't first, when we started making good money, started saving money, and then having that money work for us on the side while we're still working, still doing everything, still making good income, and then also not increasing our lifestyle to the income levels that we were at. Like we lived in our house and it was a good house. So I'm like, it sounded like I wasn't living in a tiny house or anything, so that feels bad. But like, and we lived there for 5 years. It's like we could have upgraded sooner, but we waited. Mm-hmm. And like when I was making really good money, like interest rates were down. I leased a Tacoma, and my freaking Tacoma payment was like $240 a month. It's like, yeah, I could have went and got like a big truck, or I could have went, but it's like, no, I rode that thing until the lease was up. And, we just did like, I think little things like that. And I even look back at mine, and I'm like, dude, I still could have been way more frugal. We could have house hacked. We could have bought a duplex and house hacked, or a fourplex and house hacked. And, we didn't. So I'm like, there's total extremes. My buddy, Austin, that I talk about that helps us with finances, like he is so frugal, like drives 20-year-old cars, like, and like, I'm not that frugal. Like I still want to have some fun and do stuff. And I think that's okay, but you got to decide what is the life that you want to live. He enjoys that. Right. He takes pride in the car that he drives and the money that he saves. He takes pride in the amount that he has tucked away for investing. He takes, they just recently bought like a townhouse. He was approved for more, but definitely he's like, this is where we're going to stay. Mm-hmm. Very self-disciplined in that. Which I think is awesome. But I'm also the other episode. I'm like, I think you can also have the mindset of like, go make more money, figure out how to make more money so that you can do both. So you can live the life that you kind of want, and you can invest, but you got to decide what it is you want. And I think this isn't like you should have this conversation with your spouse, because it takes 2 to tango. Oh yeah. If the spouse isn't on board to cut expenses or start investing, it's going to be really hard. And the 2 big things for divorce, I think the number one thing is finances, because people value money differently. And you got to figure out, like, get on the same page of what is the end goal. Cause you're going to be really unhappy if you're working hard to save money, but then we're not saving money because she's not on board to save money, or he's not on board to save money. A lot of the times it's actually the females that are more conservative and want to save.
Oh yeah, 100%.
The males are usually the ones that don't want to do it. So, but like, you know, and if that's you're the male that doesn't want to do it, it's like, then let her take care of the finances. Like if that's not your jam, you don't want to do it. It's actually it's different in me and Bree's relationship. She actually hates the finances. So I manage all of that. But a lot of times, like, I've seen other people where it's like the husband goes out and works, and the wife, she likes to manage the finances and manage the budget and keep all that. And that's great. But like make sure that with that, you're not just saving money, you're saving money to invest.
Right.
So, yeah, we talked a lot.
Yeah, no, I feel like this was really good because to kind of wrap it all around, the title of this podcast is The Pursuit of Wealth, right?
Yeah.
There has to be a starting point.
Yeah.
And so to the audience listeners, obviously, like, let us know how you felt about this conversation and stuff. Like, we did go off a little bit on different things that generate wealth, but I do feel like we have a great starting point. So step one is, if you can, try to make a little bit more money, you know, whether it's, like we said, the million different things that you could do.
Or cut expenses.
Yeah, or cut expenses. Cut expenses, make more money.
Figure out how to have more money left over each month.
And as you have that more money left over, save.
Yep. Get to a 3 to 6 months worth of
6
savings.
months.
Because that'll give you
peace of mind.
Peace of mind to start investing.
Correct. Then you take ideally 10 to 20% and throw it in the stock market.
Start with the stock market.
S&P 500.
Yep.
And get the bug of seeing your money work
grow
for you and grow. This is not going to get rich quick scheme. This is not going to happen in 3 months. But it's developing a habit. And then as you see that grow, find a partner or a friend that may be in the real estate world or whatever world of investing that you want to try to get into, and see if they're willing to partner with you, mentor you, help you.
Get educated.
And I think that's a great starting point.
I think that final step is like, get educated on where you want. Because you could even, it's like, if real estate doesn't interest you, just get more educated on stocks.
Right.
And start picking some different stocks that might give you a better return. You just got to get educated on that next step to get a better return.
Yeah.
So, and we'll dive in like that. Yeah, I think that's a great recap. It's like a 4-step process right there. 4 easy steps. Very generic, very easy, simple to do. We can get way more in depth with that stuff, but let us know in the comments or shoot us a message, like questions that you have. One, do we need to explain anything more, like anything deeper in this? And then also, what questions do you have with anything that we talked about? And what questions do you have about anything that we can discuss, going forward? Do you want us to dive deeper into hard money lending? Do you want to dive deeper into like how we run numbers with rental properties, or how we analyze deals, or anything like that? Like, let us know. We want this to be a tool for listeners that are on their own individual pursuit of wealth. Because like I said, everybody's situation is different. Don't compare your situation to anybody else.
Totally different.
You're investing. Don't try to copy anybody's strategy, because they could be in a totally different game. They could be in a totally different playing a totally different game than you. Focus on your life, what you want, and figure out a game plan to go forward with you. So it's your own pursuit of wealth. Everybody's pursuit is different, and we'd love to help you along that journey. So hope this is beneficial.
No, thank you.
First episode with a co-host.
Let's get it.
Until next time, we'll catch you guys later.
Welcome to the chase where the champions dwell. To the grind, to the hustle, the pursuit of wealth. Every story, every journey, every climb from the shelf. Here's to the drive, to the fight, to pursue